Hello, good evening, everyone. I'm just starting in 2 minutes. Just 2 minutes, please.
Hello, everyone. Welcome to all of you for today's session. Just let me know whether you people can hear me well. Can you hear me?
Yes.
Good. All right. So students, I gave you some homework to prepare some topics, to go through some past exam questions. Have you gone through the questions? Tell me. Have you gone through the question? How many of you have gone through that? How many of you have prepared the last lecture? How many of you have prepared the last lecture? Tell me, please. Yes. No one is responding. What should I presume? What should I perceive? How many of you have prepared the last lecture? Yes. I need response from everyone. I am not going to proceed today. I told you clearly that I want all of you to prepare the lecture before this class. Please respond, students. Tell me. Have you prepared the lecture? The last lecture. Tell me, please. 2% only. I said I want you to prepare, not to go through, not to revise. Students, you see here, you just start mixing Coca-Cola with the cucumber and mix it in blender, and then you say, hey, why it doesn't give the taste of a coffee? You mix Coca-Cola and cucumber in a blender, and then you start complaining that why it doesn't taste like a coffee, a mocha, a cappuccino. Why? Will that be a fair question by you and complaint by you that it should taste like a coffee? Coffee from Cafe Lux. It should taste like that. Or it should taste like tea. Taste like tea. Yes. How can you, when you are not adding the ingredient, when you are not following the process, how you can expect the outcome to be different and expect to be the same you want? Whatever you are doing, outcome will be accordingly. And then you should not complain. You should not blame anyone else. And then you should not blame anyone else. Who to blame then? Yourself. You are for a class with Mr. Hamzah. I know you are here in the online classes, despite of the fact in Mauritius, there are so many physical classes available. Teacher teaching since decades, but you are here with me in an online class, which is not that much interactive. The way you feel interaction in a class. And you are not following my advice. How things will be different? I fear. Rather, not fear, I'm sure. The result will not be the same. Which should have been if you follow my advice. Now, so we are going to solve past exam question today. I'm asking you a question. Answer me. What is meant by risk of material misstatement? What is meant by risk of material misstatement? Yes. What is risk of material? In simple words, what you have understood so far. What is the meaning of risk of material misstatement? A student has given me the breakdown. Okay, good. More answers, please. More answers, please. Risk of material misstatement. More answers, please. I want all of you to respond. Good. Okay. Students, risk of material misstatement in financial statements. The meaning is that yes, financial statements have not been prepared. The risk is that financial statement may contain some errors, some omissions, some understatement, some overstatement, not recorded as per IFRS, not recorded as per laws and regulations. Yes. Now, and I told you audit risk includes risk of material misstatement as well as detection rate. Now we have to solve past paper questions today itself. So the question number 1, they said that this second part, evaluate the audit risk to be considered in planning the audit of TED company. You know, you people have not gone through the question. Only 2 or 3% have done that. Now it will take our time, wastage of time. If you would have read this question at home before coming to class, I would have started solving the question immediately. But now I need to give you time. Yes. So take 5-6 minutes, read these 2 pages of question. Everyone, please. And once you have done it, send me a message done in the chat box. Be quick. Start reading it. It is a page number 30 of your notes. 30. Yes. Here is the scenario. This is how in exam scenario you have to solve. You are a manager in the audit department of Craigie and Company. Student, this is email, briefing notes. We have to respond like this. To Jack Hackett from audit manager. This is the response we are writing regarding or subject Ted Company audit planning. Audit planning. Now, introduction. Paragraph. Okay, I'll write introduction paragraph. Then the first thing is A part is matters specific to the planning of initial engagement. Matters to be considered forming audit strategy in an initial engagement. This is the first part. This is the first part, A. Its answer will be written. Then the second part, that is evaluation of audit risk to be considered in audit planning of said company. C. Audit procedures on portfolio of short-term investments. The first part, it is and the second part is that is audit procedures on earning per share, EPS. And then conclusion paragraph. This is the format of the answer. You know that there are the skills to be learned, professional skills mark, communication skills. These 4 marks are for communication. For writing this format, yes, communication skills. And using appropriate heading as well, further headings as well. Now, next. Since we have to solve part B, in the introduction paragraph, what we will write? The following briefing notes regarding the planning of, regarding the audit planning of said company explain the matter to be considered in an initial engagement. Significant audit risks have been evaluated to be considered in audit planning and some of the audit procedures that can be performed on portfolio of short-term investment. And EPS, earning per share, have been given. That's it. So this is the introduction paragraph. Now, the B part we have to solve. I will start with it. Now come here. You are a manager in the audit department of Craigie and Company, a firm of chartered certified accountants. And you have just been assigned to the audit of TED Company, a new audit client of your firm. Now, so the first is new audit client. First audit risk is new audit client. This is heading. We will discuss it later on. TED Company is a new audit client, newly listed company, and has grown rapidly. Second audit risk is newly listed company. Another risk. Sorry. Next. Come here. TED was formed 10 years ago by DD, a graduate in multimedia computing. The company designs and develops and publishes computer games, including many highly successful games. You see here. Now, just a minute, please. Now, which have won industry awards. In the last 2 years, the company invested 100 million in creating games. It means they are investing in the research and development. Sales are in 60 countries, international operations. And then they say production takes place overseas. So two risks we have identified. One is research and development cost. First. Second is overseas, international sale and production. It is, yes. Next. The next is a computer games are largely sold through retail outlets, but approximately 25% of TED company revenue is generated through sales made on website, e-commerce. 25% of sales, e-commerce. 25% of sales through website. Through website. Next. Next is say, students, if you are getting bored, remember, there is one way to avoid boredom in the class. Studying regularly. I'm doing question. Those who have prepared the last lecture, they would not be getting bored because they're getting understanding why I am identifying these points. Other, please. So I request you to prepare it on a regular basis. Now, in some countries, products are distributed under licenses, which give the license the exclusive right to sell upon that country. The cost of each license depends upon estimated sale in the country to which it relates. License lasts for an average 5 years. Okay, it is deferred over the period of a license. Add amount of deferred income. License income. Yes. The next heading will be license income. The income, deferred income in financial statement is 18 million. And income of license is recognized on average 5 years. Yes. Now, the next, as part of the 5-year strategic plan, TED company obtained a stock market listing in December 14. The listing issued a significant amount of money, but shareholdings are held. Okay, leave it. Family. Despite being listed, the company does not have internal audit department. There is one non-executive director. Okay. Corporate governance issues. No internal audit department. One non-executive director. Now, recently a small treasury management function was established to manage the company's foreign currency transaction, which include forward exchange currency contract. It can be an order. The treasury function also deals with short-term investments. In June 2015, cash of 8 million was invested in portfolio of equity shares held in listed companies, which is to held in the short term as a speculative investment. The shares are recognized as financial instruments and cost 8 million. The fair value of shares at 31st May is $6 million. Now, short-term investment. So 8 million cost and recognized at same value, same amount. Fair value at year end is 6 million. Right. It is speculative investment in share. As a listed company, TED company is required to disclose its earning per share. Earning per share is another risk here. EPS. Earning per share, EPS. Now, then is profit margins we can calculate. EPS we will talk about. Yes, development cost increased by, you see, intangible asset, 23 million. Relevant data. Intangible assets. Increased by 23 million. Development cost. Now, yes, the last point is, that is margins, profit margins. If we calculate profit margin, gross profit margin, 6,500. Last year it was 40,000. Okay, calculated as your calculation. 40 million divided by 60 million, 67 million. It was 59.7%. To this year, 65 to 98. 66.3% increased. Next is operating profit margin. 13.7%. To 12.2%. Now, students, remember marking scheme. So far, the marking scheme is accounting issue, normally 3 marks each. Normally. But if one accounting issue has multiple aspects, 2-3 aspects, then marks may increase up to 5 for one accounting issue. Yes, ratios, trends, properly discussed. 1 mark each ratio. For example, 1 mark for these 2 marks, profitability ratios. then other risk, just like that risk, which is generic statement, just like that corporate governance, newly listed company statements. They have 2 marks each. This is how marks are awarded. Note down. This is how marks are awarded. Now, next. So you see here, this question we are doing, it was having 17 marks. Sorry. It had 17 marks, this part. So it means how much, right? 2 marks, accounting issue, EPS. Accounting issue, 6, 3 and 3, 6 and 2, 8. 2 marks, 10, 2, 12, 14, accounting issue, 17, accounting issue, 20, 22, 24 marks. In exam, once you have done analysis, now you can choose the best point for the mark, available marks. You have never right to you have never to write excessive. Remember, never to write excessive. Only write for the available marks. I hope you got the point. Now we will start writing the answer. New audit client. Craigie and Company, the firm name, is going to audit the TED company this year for the first time. So we may not have enough understanding and knowledge of accounting system, financial issues, and other financial statement related methods. So we may not be able to plan and perform audit work properly to detect material misstatements in the financial statement of TED company due to this detection risk. You see, audit risk explains. Now, let us proceed further. Furthermore, the opening balances of this year accounts of TED company may be misstated as they are the closing balances brought down from previous year financial statements which were not audited by Kiragi company. Yes. Now, let us proceed further. This is for 2 marks. Done. Newly listed company. TED company. Obtained listing last year. Obtained listing last year. And hence have not and hence its management may be biased to show improved financial statement results to the market. So they may have manipulated financial statements. Significant increase in profit in sales from last year. How much is increase in sales from last year? 46.3%. Around 46.3%. Maybe because of manipulation of sales, and sales may be overstated. Yes. In addition, huge amount of capitalization of development cost, 23 million, may have done to just boost profit an assets amount in financial statements. Students, these two examples are very much important. Normally, students write this and they think it is enough. You may get 0.5 mark or maximum 1 mark if you write only one this. Mean you have to just quote, for example, what specific they may have done. Now, let us proceed further. You see, these are general statement and the risks attached with that. Development cost. Intangible assets increased by 23 million due to capitalization of development cost. Due to capitalization of development cost. Due to capitalization of development cost. Now, which is 23 million divided by total assets. How many total assets they have? 134 million. Materiality. Wherever you find an amount, calculate and discuss its materiality. 23 divided by 134. 17.16% of total assets. So it is material to. What are the materiality thresholds? Tell me. What are the materiality thresholds? Students, tell me. I told you in the last lecture. Tell me, please. What are the materiality thresholds? More thresholds. 1% of total asset and no, 1% is done. I told 3/4 thresholds. Wrong. 0.5% of sales. 5% of profits. Yes. These three at least you should memorize. 0.5% of sales. Now, as per IAS 38, research cost should be expensed and development cost can be capitalized if the product being developed is technically and commercially feasible and the company has intention and resources to complete and launch the product. Launch the product. Now, next, it appears that, okay, the risk is that company may not have made any distinction because they are silent. They just told they have capitalized it. We have found it from financial statement, distinction among research and development cost, and may have capitalized all. Or, and development cost capitalized for the product may not be commercially or technically feasible. Hence, not meeting the criteria for capitalization. And assets and profits may be overstated while expenses understated. Yes, specifically tell which item may be overstated, which may be understated. Now, this is the counting issue. Materiality treatment applied to scenario, risk, and impact. Now, said company has sales in 60 countries, 60 countries, and 60 countries, and production takes place overseas. As per IFRS, Now I don't remember the number of IFRS. I remember IS 21. But when you are confused, simply write as per accounting issue, as IFRS. All the transactions should be recorded at transaction date, spot rate, and any balances should be converted at or retranslated, retranslated at year end closing balance. At year end closing balance. Now, next. The risk is that company might be using incorrect rate for recording transaction and may not be retranslating year-end closing balances at closing rate, and hence purchase cost of sales. What can be misstated? Cost of sales, sales, and inventory may be misstated. Misstated, both chances, understatement and overstatement, both chances. All right, e-commerce. Company has 25% of sale through website. multiple risks attached with the online sales, e-commerce, such as cutoff may not have been established cutoff point properly for sales of the year. Secondly, as per IFRS 15, the timing at which performance obligation is satisfied by the company for sale of goods may not have been identified correctly, leading to misstatement of sales in financial statement. You see here. IFRS 15. Now, next, license income. License income. What is license income? You will discuss its materiality. Deferred income from license sales is $18 million divided by 134 million. Total assets are 134, yes. 134 million. 18 divided by 134. 13.4%. 4% of total assets. So it is material to financial statements of company. So it is material to financial statements of company. Now, next. As the assets, the licenses are sold for the average of 5 years, and cost is and the amount is received in advance. So it is the correct treatment to record the amount received as deferred income at the time of receipt. Yes. The company is, just a minute, please. One thing I want to see from here. Over the period of license. Okay. And the company recognize the income over the life of license. The risk is that the amount recognized and average life of license may not be the period on which the amount of license is recognized, and the average and the life of the license may not be the same. Yes, resulting in misstatement, both possibilities, over and under both possibilities, misstatement of liabilities, deferred income is liabilities, and income in financial statements. Yes, both possibilities, liabilities, yes. Three marks done. Now, let us proceed further. The company has no internal audit department and only one, means no audit committee. Means no audit committee. So controls of the company are not being monitored and improved by internal audit at all. And financial statements are not being overseen for integrity by audit committee. So there is a high risk that accounting records may contain a lot of misstatements, resulting in misstatements, material misstatements in financial statements. Yes. Next. The next is short-term investment. Students, discuss materiality of 8 million and 2 million. The 8 million cost of short-term investment is 8 divided by 134 million. That is equal to 5.9% of total assets and reduction in fair value of $2 million is 2 divided by 134 million, equal to 1.5% of total assets. So both are material to financial statements. So both are material to financial statements. Now, what next? As per IFRS, short-term investments. Please note down the answer. I will dictate. As per IFRS, the short-term speculative investments are recognized at fair value through profit and loss. But here, At year end, fair value of investment is 6 million, but it is held in financial statement at cost of 8 million, which is against IFRS requirements and guidance. Hence, profits and assets are overstated. Sorry, it should be written down. Down to 6 million. And a loss of 2 million should have been recorded. Hence, assets of TED company are overstated by 2 million. Yes. Now, next, earning per share, EPS. You see here what they have done. They have calculated EPS, adjusted profit, divided by number of shares at year end. As per IAS 33, again, if you don't remember number, write as per IAS or IFRS. Earning per share is calculated by dividing the profit attributable to shareholders with weighted average number of shares for the year. But here, TED company has used adjusted earnings in the and used shares at year end in denominator. Both of these are against the provision of IAS 33, and EPS is misstated in financial statement. And EPS is misstated in financial statements. is EPS is misstated in financial statements. Now, secondly, for the listed companies, the figure of diluted EPS has to be disclosed as per IAS 33, which TED company has not disclosed. Yes. So EPS is also done. Earning per share. Next. The next is margins. Student, gross profit margin has increased. Please note down this. I will dictate it. Gross profit margin has increased from 59.7% to 66.3% this year, while operating profit margin has fallen from 3.7% to 12.2%. This inconsistent trend between the margins may be because of some cost omission from the cost of sales, or there is a risk that some costs may have been misclassified. Misclassified. So students, this is how it is. Now we have completed this question. Of course, the remaining parts, once you will do, then you can solve. This question will be complete. And you see, I have dictated you the answer in 1 hour around. Yes, in 1 hour around, I have dictated you the answer. But still, you know, when you type yourself, and it is more than the required. So it can be done easily within the time limit when you are doing it yourself. The next question is, student, do you need a short break before going to the next question? Do you need a break, or should we go to the next question? Tell me frankly. Okay. Take a 10 minutes break. After 10 minutes, we'll be back, and then we will proceed towards the question number 5. Those who don't want break, there might be some people who don't want break. I request them, go to the question number 5. Here it is. Here it is, the question number 5. Page number 51. Read it, the scenario.
Yes, please, everyone now. Open the question number 5. Everyone read it. And once you have read it, the requirement is here. Significant risk of material misstatement. 20 marks. So please read it, everyone. 3, 4 pages. 4 pages there are. 5. Yes. So please go through it. 55. From the page number 51. 5 pages are there. Read these 5 pages. And once you have done it, drop a text here, please. I'm waiting your response before I start solving this question. Yes. Have you gone through it? Please tell me.
All right, now let us proceed further and identify points in it similarly. So similarly, I will not redraft the format again and again. Okay. Now, here we are. You are a manager in the audit department of Snow and Company, a firm of chartered certified accountants, and you are responsible for the audit of Margot Company. The company has a financial year ending 30th June 2009, and you are about to start planning the audit. Audit manager, audit partner met with finance sector, and the following information is here. Okay, come here. Right, planning. Evaluate significant risk of material misstatement. You should not include the risk of material misstatement relating to valuation of company bearer plants. Only this should not be considered. Everything else should be considered. Background. Margot was established 30 years ago by Jim Margot, who began processing the fruit grown on his family farm. Yes. I'm sorry. Yes. To make a small range of food products, including canned fruit and the fruit juice. The business was relatively small until 10 years ago, when the company began to expand by acquiring more farmland with different crops and building new production facilities. This extended the range of food products which could be processed, which now includes these items. Okay, the company is not listed. So they sell through the online as well. Okay. The company is not listed, majority shareholders. Here they are. Online sales. The first is online sales. The sales made through the company's website grew significantly. The finance sector believed that in response to the advertising campaign costing this, which promoted the Fructose brand, which coincide with the launch of new online sale portal, website designed to make online ordering easier. To encourage online sales, the company has regular special offers, which with discount periodically offered a selection of products lines and offered such as buy one, get one free. And there are two issues. Now, the one is risk of material misstatement. Risk of material misstatement. The first is online sales. Now, so the problem is special offers. I will simply copy the data. It grew significantly. Copy and paste. Then this is another issue. Yes. Online sale then is Research and development. Research and development. Okay. The board approved a budget of this packaging. This amount has been spent. Okay. This all issue cost. The second heading, the relevant data we are copying. Loan. Okay. Loan. Factory damage. One of the company's several factories used to process were damaged. This is the factory damage coming next, exhibit 4. Okay. Impairment of factory. Its detail is coming next. All right. Then, use of auditor's expert. The fruit grown on trees and are which were recognized at fair value. So valuation, they say, okay. Now, valuation of bearer plants. They say it will be considered later on. Now come here. Intangible assets. 50 to 525. Here are the software development cost. Yes. Software development cost of how much? 30 million. Yes, research and development cost we have. Yes. Advertising cost capitalized. So advertising cost. So this is the intangible assets. Research and development we have already mentioned above. Advertising cost 220 million capitalized. Now, property plant equipment. This is the impairment. Okay. And this is the information. If you have gone through it, it is very valuable as per accounting standard. I will use it when I'll be, okay. They say, there are two issues in it. One is this, impaired factory. The second is provision. They said the amount has been provided in current liabilities. Provision for restoration of factory. Yes. This, the next point is here. Next. This analysis is very much important. And then of course, write up. Now, chemicals have been used, inventory valuation. Yes, it is a legal issue. And again, it is the now prohibited, penalties, provisions. Yes, legal issues and provision for penalties. Next point. Yes. So, furthermore, ratios. Current ratio is here. Gearing ratio is here improving. Cash. Yes. Rows, profits, margins, revenue, online sale. Yes. Different analytical review of financial statements. This all data can be used. Yes, in the discussion of that. Now, come to the points. You see here, online sales. Now here's some points we wrote in the last question. Now, the companies, the online revenue, sorry, the online sales is increasing rapidly through website of company. And this year, it is, where it has gone, here it is. This year it is 2.4 million divided by 35.6 million total revenue. You just calculate 2.49 divided by 35.6. It is 6.99% of total sales of company. So it is material to financial statement. Same point. The online sales has various risks of material misstatements attached, such as incorrect cutoff of sales may be implemented. or and incorrect timing of revenue recognition may be used contrary to requirement of IFRS 15 at the time of, that is, when performance obligation is satisfied, then revenue should be recorded. Hence, risk is that sales may be misstated over or under. Now, moreover, in my opinion, this point has minimum 3 marks, maybe 4, minimum 3 marks. Moreover, company offers discounts periodically. And sometimes buy one, get one free offered for limited time. The risk is that the accounting of these discounts and offers is complex. The accounting of these discounts and offers is complex. And the risk is that company may not be able to record these correctly, resulting in misstatement, over and above both of sales in financial statements. Here it is. Now, let us proceed further. Research and development cost. You see how risk is discussed, how impact is discussed. You see here, accounting issue, how it is discussed. Research and development cost. The company has spent 220,000 on development of a packaging product, which is amount is 220,000 divided by how many assets are there? The total assets. To 220,000, it is 12.5 million. 12.5 million. What is the percentage? 220,000 divided by 12. Yes, 1.76% of total assets. Yes, and we can calculate for profits as well. Profit is 2,100. 2.1 million. Yes, 22,000. Sorry, 22,000. 220,000 divided by 2.1 million. Around 10% of total profit for the year. So it is material to financial statements. The same treatment as per IAS 38, research cost should be expensed, while development cost should be capitalized for product if it technically and commercially feasible. If it is technical and commercially feasible, and company has intention and resources. You see, revision of IFRS. This is revision of IFRS to complete and launch the product. Here, the company has paid 220,000 cost to ProPack for development of packaging product and has capitalized all the cost. ProPack, sorry. And has capitalized all the cost paid. And it seems no distinction has been made among research and development cost. You see here, because they have capitalized all. Whatever has paid, they have capitalized it. Next. Moreover, has made among research and development cost. Moreover, the prototype of the product, they said that in the question, is in testing phase, which means that technical feasibility of the product has not been established yet. Has not been established. See, that's prototype. Has not been established yet. So it is incorrect to capitalize its cost in that case. So the cost should be expensed. Hence, assets and profits are overstated and expenses are understated. Loan, remove the loan. Yes. Yes, just see here. You have to utilize the given data, given information. You have to utilize that. Yes, just a minute. Okay, now, next point, impairment of factory. Now come to the question. Again, impairment of factory. It is here. Carrying amount includes 880,250. Impairment loss of 210250 had to be recognized, need to be recognized. This is carrying value, value in recoverable value, value in use, and here it is. Come here. The impaired factory is 880250. 880250 divided by divided by 12.5 million. That is equal to, we have to calculate its materiality and discuss that. Seven percent of total assets of the company. So it is material to financial statements. Now, as per IAS 36, an asset is impaired when its carrying value is greater than its recoverable value. And recoverable value is higher of value of its fair value less cost to sell and value in sale in its current condition. In its current condition. They say its value in sale they have calculated if it is repaired. The company has incorrectly calculated value in use by assuming based on sales estimates once the factory is repaired and new machinery is put into use. New machinery is put into use. This is clear in contravention of the guidance of IAS. Clear or breach, yes. And hence, the loss, impairment loss of calculated of two, how much loss they calculated? 210250. 0 on factory is incorrect. And in fact, its value in sale, value in use, if the value in use of the factory is calculated in its current condition, impairment loss would be much higher. Hence, assets and profits are overstated while impairment loss is understated. Clearly, impairment loss is understated. Now, next, software development cost. Let us open that. Students, you are getting understanding how to write answer? Tell me. You are getting the understanding or not? Tell me, please.
Yes.
Good. So the next is software development cost. 50 to 80. So software development cost is we can calculate its materiality and technically feasible. It is commercially feasible. It is bringing the benefit. So it is correct to capitalize. You can note down these quick points. I'm not going to write its answer. First of all, you will calculate and discuss materiality, and then you will discuss cost can be capitalized when technical and physical and commercially feasible. So software is being used by the company, and sales are growing because of it. So it's technical and commercially feasible. It's good to capitalize its cost. While advertising cost, as per IAS 38, can never be capitalized. That should be expensed. And the company has capitalized 220 million. You can discuss its materiality as well. I repeat, advertising cost, discuss its materiality, calculate and discuss. And then as per IAS 38, advertising cost cannot be capitalized. This is incorrect treatment, what they have done. Hence, expenses are understated. And profits and assets are overstated. Now, supervision for restoration of factory. First of all, you will discuss materiality. Materiality, you will discuss that, and then afterwards, what you will do is, afterwards, what you will do is, as per IAS 37, provision can be recognized or should be recognized when there is a present obligation for which outflow of economic benefit is probable, for which outflow of economic benefits is probable. Now, here, factory is damaged, but the company is not obliged to repair it. And buy new machinery. Company is not obliged to repair it and buy new machinery. So recording the estimate cost as a provision is incorrect. So liabilities and expenses are overstated So these two things are overstated. That's it. Now, student, remaining 1 or 2 points, you can read the answer. Answer I have given it at the end of this question. You see. So I have given the answer. The question has gone. Just a minute, please. Now, what is the home assignment? What is the home assignment now? Students, you people must have to do question number 2 and 3 at home. 2 and 4. Question number 2 and question number 4 at home. Question number 4 is Adams Group. A very good question. Question number 2 is Delhi Company, I think. Yes. Question number 2 is Delhi Company. And question number 4 is Adams Group. You have to try and solve these questions at home. In the next class, what I'll be doing, I'll solve one more question with you. And I will shift to the next topic, business risk. I'm telling you, business risk. And then if we see our course plan, let me show you the course plan. Yes. As per course plan, AAA batch B. Yes, here it is. Today is 28th July. We have done 2 questions. In the next class, I will solve one more question. I will discuss business risk and one more question. I may do 2 questions, one on business risk and one on audit risk. So now, and one more class on practice questions. One more class. So in this total, 3 questions I will do on audit risk and minimum 2 questions on business risk in class. I may do 4 questions on audit risk. Okay, so this is important. 5 questions on this section in the class, and then there is test. I'm telling you one thing, please be aware. I will give the test. The students who will not score 40% marks minimum. How many I'm saying? 40%. I'll penalize. I'm sorry to say. Because what I'm saying, I'm doing questions and students are leaving class. You're not working. I'm forced to do this. And that penalty may be restriction on the account. I'm telling you, you may find it bitter, but I have to make you work. The previous sessions, this is my bitter experience. My bitter experience. The students come, they join, they don't study. In the last month, then they say, oh my God, they failed their exam. So I have to make you work. So tell me, should I be strict or not? Tell me. Should I be strict according for the homework and the test? Tell me. What do you say? Should I be strict for homework and the tests as well? Only 2% said yes. What about others? All right. So get ready, please. What on the only motive behind all that is to prepare you people for exam. To prepare you people for exam. I'm telling you, the test is mandatory. Minimum 40% marks. This is very low benchmark. I should have said 80% marks. Instead, I would have said minimum 80% marks because it is one topic, one area. So I'm telling you minimum 40% marks. You who will not get, I will be placing restriction on the account. I'm sorry to say, because I don't want my results to be ruined. I'm telling you. So start preparing it. See you next week. Goodbye. Goodbye.